Deep inside Washington, D.C., there's a place where money is brought into existence nonstop. Day and night, powerful machines transform blank paper into fresh currency, injecting hundreds of millions of dollars into the economy daily. It sounds enormous, almost unbelievable. But that spectacle hides a much bigger truth. Physical cash is only a sliver of modern money. Most of it isn't printed or touched at all. It exists as digital numbers, quietly expanding on computer systems by billions of dollars every single day. So where does all this money actually come from? Before a dollar ever lands in your bank account, it's already passed through governments, corporations, and financial institutions, often without ever being touched. In many cases, it's created with nothing more than keystrokes on a computer. To really understand how we ended up here, how money fuels the economy, pushes prices higher, and quietly pulls people into debt, we have to rewind way back. Before money even existed, thousands of years ago, trade was personal. If a farmer needed a new tool, he'd visit a local toolmaker. Maybe the farmer didn't have anything valuable on hand at that moment, but the toolmaker trusted him, so they made a deal. The farmer would repay him later with food from the harvest. That promise, based purely on trust, was enough. And sure enough, weeks later, the farmer returned with crops, and the debt was settled. As communities grew, people wanted faster, simpler ways to trade. Instead of promises, they began using things everyone needed: grain, cattle, salt. These items held value because they were useful and relatively scarce. A farmer could now walk away with a tool instantly by handing over a specific amount of grain that felt fair to both sides. Trade became smoother, productivity increased, but there was a problem. These goods were bulky, hard to transport, and not exactly durable. As trade expanded, people needed something better. That's when metals like gold and silver entered the picture. They were compact, valuable, and didn't rot or expire. With coins, trade exploded across continents. Goods moved from China to Europe. Economies became global long before the modern world ever existed. Still, gold had its limits. Carrying large amounts was heavy and dangerous. This is where money took its next major turn. In 17th century London, people began storing their gold with trusted goldsmiths. For a small fee, the goldsmith would keep it safe and issue a paper note in return. That note promised the holder could retrieve the gold at any time. The paper itself had no value, but everyone trusted what it represented. Eventually, people stopped exchanging gold altogether and started trading these notes instead. Paper had become as good as gold. Then the goldsmiths noticed something important. Almost no one ever came back to claim their gold. That realization changed everything. Goldsmiths began issuing extra notes, loaning out promises that weren't backed by real gold. This was instant money, created from nothing, with the expectation it would be paid back with interest. If a goldsmith loaned the value of 100 gold coins, he didn't lose anything. He simply wrote a note worth 100 coins. That note circulated through the economy, buying goods and services, while the borrower eventually paid back 105 coins. From a single loan, money multiplied, without a single new coin being minted. More money now existed than gold to back it. And as long as everyone didn't demand their gold at once, the system worked. Replace goldsmiths with modern banks and paper notes with digital balances, and you have today's financial system. Almost everything we buy now is digital. Even our identities exist online, sometimes in ways we don't realize. Personal data is bought and sold constantly, often without consent, exposing people to scams, identity theft, harassment, and endless spam. That's why tools that help remove personal data from brokers have become so important in the modern economy. But while money has gone digital, its creation still follows that same centuries-old logic. This shift, creating money through loans, completely changed how economies function. Before, money just moved in circles. Imagine 4 people sharing $100. The money changes hands, value is created, productivity grows. But eventually, the distribution becomes uneven. Some people end up with nothing to spend, trade slows, and progress stalls. That system only works in theory, not in real life. Adding new money into circulation keeps things moving. It allows businesses to expand, workers to get paid, and entire societies to advance. In today's system, that constant flow of new money isn't optional, it's essential. And this is where banks enter the story in a way most people never think about. We're taught that banks store our money, that they safeguard it. But in reality, when you deposit money, the bank owes it to you. The balance you see isn't cash in a vault, it's a promise. And when banks issue loans, that promise flips direction. They create new money by typing numbers into existence. That's not a metaphor. That's literally how money is made. And while this process has powered massive growth, it's also planted the seeds for something far more dangerous. one that shapes inflation, government debt, and the financial pressure felt by everyday people, and that's where the story gets even more complicated. When a bank creates money through a loan, it doesn't feel dramatic. There's no printing press, no alarms, no vault doors swinging open. It's just numbers appearing in an account. But that quiet moment is where modern money truly comes to life. And once it's created, it doesn't sit still. That loan might help someone buy a car. The dealership uses that money to pay employees. Those employees spend it on food, rent, and entertainment. Businesses pay suppliers. Suppliers pay workers. One loan turns into hundreds of transactions, powering real productivity, jobs, services, and innovation that wouldn't exist otherwise. In that sense, creating new money isn't inherently bad. It's what allows a modern economy to grow instead of freezing in place. The problem begins when the growth in money outpaces the growth in real goods and services. If society produces more stuff, more food, more housing, more technology, new money helps grease the wheels, but if productivity slows and money creation doesn't, prices rise. Suddenly, there's more money chasing fewer goods. That's inflation. And once it takes hold, it quietly erodes purchasing power. Your savings buy less, your paycheck stretches thinner, and the system starts to feel rigged, even if it wasn't designed to be. Because of this risk, banks are supposed to limit how much money they create. In the past, they were constrained by how much physical cash they actually had on hand. They could only lend a fraction of it. But today, those limits are far looser. If a bank needs more reserves, it doesn't panic. It simply goes to the central bank. And this is where things start to feel almost surreal. When the government needs money, it doesn't just raise taxes and wait. It issues bonds. A bond is essentially an IOU, a promise to pay back borrowed money with interest over time. Banks, corporations, and even foreign governments buy these bonds. The government uses that money to fund everything from infrastructure to salaries to social programs. That money flows back into the economy and eventually returns to the banking system. But here's the catch. The government almost always spends more than it collects. When tax revenue isn't enough, new bonds are created. That means more borrowing, more debt, and more interest that has to be paid later. The money to service that debt comes from taxpayers, but often that still isn't enough. So the cycle repeats. New bonds pay off old ones. Debt stacks on top of debt. This isn't unique to one country. It's how much of the world operates. And while it sounds reckless, it's not necessarily broken. It's just inefficient. The system assumes that future growth will always be strong enough to justify today's borrowing. But when money is created faster than productivity improves, cracks begin to form. Inflation rises. Trust weakens. People feel like they're working harder just to stay in the same place. What makes this system especially confusing is that most people never see it happening. They just feel the results. Higher prices, rising debt, a sense that money doesn't go as far as it used to, and they're not wrong. At its core, modern money is built on promises. Promises that banks will honor withdrawals, that governments will repay debts, and that future productivity will cover today's spending. As long as those promises hold, the system functions. When confidence breaks, everything becomes fragile. And yet, there's a powerful upside hiding in all of this. If newly created money were consistently directed toward truly productive uses, education, infrastructure, innovation, and businesses that create real value, the long-term returns could outweigh the costs. Roads, schools, technology, and efficient systems don't just spend money. They multiply it by improving how society functions. The issue isn't that money is created through debt. It's where that money goes afterward. When it fuels speculation instead of productivity, inflation rises without real growth. When it concentrates in fewer hands, participation in the economy shrinks. And when it's used to patch short-term problems instead of building long-term solutions, the cycle becomes harder to escape. That's why understanding how money works matters more than ever. Because money isn't just paper. It's not just numbers on a screen. It's a system of trust, incentives, and decisions that shape nearly every part of modern life. From the price of groceries to the size of national debt, it all traces back to how money is created, distributed, and controlled. Once you see it, you can't unsee it. The machines printing cash, the banks typing loans into existence, the bonds funding governments, they're all pieces of the same engine. An engine that can power growth, innovation, and prosperity, or quietly drain value if it's pushed too far, too fast. What's driving all of this isn't malice or conspiracy. It's a system built by people trying to solve problems quickly, often assuming tomorrow will be bigger, stronger, and more forgiving than today. It runs on shortcuts, expectations, and faith in future growth. The real issue isn't whether money should stop being created at all, it's whether the way we create and use it actually delivers value that justifies its cost. because money doesn't simply reflect what something is worth. Over time, it quietly decides what society rewards, what it neglects, and ultimately what it becomes.